People say, yes, the data set and everything, but when you buy the right property at the right value, I think that's what you have to look for. We try to look for value.
There's one thing that one ultimate piece of advice for anyone at home listening that's embarking on their property journey, what would it be?
Hold it.
Hold it. Done. Simple.
Simple. Hold it. An asset grows. Everything else declines in value because inflation.
Welcome to Property Banter by Pinnacle Buyers Agents. Today, we've got Che in the studio, and we're going to be talking about insider secrets, what you should be looking for when buying your next investment property. Please like, share, subscribe. We appreciate your support. Let's get into it. Welcome, Che. How are you?
Thanks, Michael. I'm good. Thanks. How are you?
Very good, buddy. Very good.
Good to see and be here.
Yeah,
in person,
it is.
right? So, I'm not a camera guy, so you're the one.
Yeah, 100%, 100%. It's good to see you come up to the sunny state and get some rain on the first day.
First day. I always bring that from Melbourne.
We're selling the sunny state, but it's not sunny today.
Yeah.
So we want to get into today. This is why we got you. We want to get into the insider secrets. We want to know. Well, I already know actually. What I want everyone else to know. What I want everyone to learn that's listening and watching this podcast is our insider secrets. We want to throw some insider secrets out there of how we look for deals, so that people out there that are looking to go it alone, or they've been following our content or considering using us or whatever, and they want a bit more information on what we do and how we do it. We want to lay it out. We want to explain the strategy of how we find value, how we see value, and how we find those deals. Or I pretty much just explained it then. It's value.
Yeah, and you want to let people know your secret sauce.
Let's go.
Okay, let's do that. So, what do we look for?
Yeah.
What's Pinnacle's values?
Value. Values is value.
Values is value.
Oh.
Right, so we look for value, but how do we find value? And where do we find value? I think it's the most important aspect when you're looking for purchasing your next asset, be you an investor or you're working with your BA, whoever you are. So I think it's important for us to understand what is that you're buying, why you're buying, where does it fit into your strategy. Yeah. So once you have that view, I think obviously there are different types of markets. Markets within markets, 15,000 suburbs. Everyone says
there's no Australian property market.
Exactly. Right? So it's always something that's happening somewhere. And how do we find them? I think first and foremost, if you really look at it, it's demand supply. So people talk about demand supply. Hey, how do I know? Just for an investor who is not tech savvy, who doesn't have any tools, I think the simple part is to go and check how quickly the properties are selling. Follow market, demand supply. As I said, how do you track demand? What's the stock on the market? Sorry. It's essentially, if you look at supply side, right? So what's the stock on the market? What's the inventory looking like? How many properties are up for sale? But how quickly they're selling as well. That's the demand, right? So if you see both of them and you see there is a trend that talks about decreasing supply, there's no stock to buy, but the people who are very interested to buy, like all of us, we're trying to get into the same market. Look at Townsville, look at Perth. Once they're in the peak of the time, you know that properties are selling in a week, less than a week, in a day probably, right? The moment they get listed.
People are overpaying by so much just to get in.
Just to get in, right? So that's what it is. So you need to observe the trend, long-term trend. The stock on the market keeps going down. The demand keeps increasing. Properties are quickly selling. There's nothing to buy, which is a key indicator. The second one that you see is always before any property goes up or any market goes up, you need to see that the rents actually go up, because that's when the investor starts coming because they see value, right? So for the money that you're putting in, you need to see that the rents are abnormally high compared to a peak market. When you go and check a peak market today, the yields could be around 3%. Whereas the same market 2 years back, the yields could be 5%. That's when the investors flock in. And once they come in, obviously rates go up, the prices go up. And then once the prices start speaking up, you know that the yield goes back to normal to every single market. Then people don't see value as an investor because your returns are less. So what does that say to you? So you need to find a market where you're able to generate yield and there is a good demand and low supply. That's a very simple metric. That's the first thing. That's what drives any market. Demand supply, that's economics. It has nothing to do with property. But that's what really we are looking at in terms of, what is the first metric that we go and check? What's driving the market? What's happening? That's the first metric.
I love the fact that you said that, and I'll tell you why. So regardless of data sets and all the data we have available, obviously we'll plug hashtag, but out of all the data sets we have, back in the day, me out there, 10, 15 years ago, that was one of the first ones I looked at. And we were buying Sydney yields were 6.5 to 8%. Right, 8.4% was my best Sydney yield that I bought in 2013, just before as the market was taking off, and that's when rents are the strongest. And then the growth curve comes, right? So that's when the market grows. So now we're seeing markets that have similarities, and I want to say one of the touching on that, the biggest thing that I look for is the value, and having investors active in a market tells you that market is affordable.
Yep.
So when investors are active, it's usually first home buyers are both active as well, right? Okay. And if they're active, then obviously owner-occupiers are active, and upgraders that are upgrading the family home to another property, they're active as well, right? They're usually more prominent at the end of a growth cycle, because then they have that huge equity and they upgrade the home. But a healthy market has a whole heap of different buyers. It has all of them.
Yeah.
Right. Whereas parts of Sydney that are incredibly affluent, they won't necessarily have first home buyers. They won't have investors. So these markets that we're looking at as investors, buying that value, is looking for that. Like we just purchased that one, and here's a shameless little plug for us. But that $615K purchase of a 4-bedroom home that rents for $750,000, and it's only a few years old.
Yeah.
Right. That's a great market.
How much it costs to build that now? Think about it.
Exactly. So I used to buy this sort of stuff back in the day, and it hasn't changed. It doesn't change. It's just we recognize patterns and we move to different markets. That's
exactly.
Yeah.
And you spoke about this, you touched on it, and it's a good segue. Affordability. Right. So the other metric, the next one is affordability. There are markets which look cheap, $400,000 property, but if you really go and check the affordability of the people living in the suburb, it could be 40 to 50 years to own. Whereas there could be properties in a nice, better socio-economic, but the price point is probably 600, 700, whatever it could be. Realistically, on paper, it looks expensive, but for the people living there, it could be 25, 30 years to own. That's the best place that you want to enter. Anyway, you see 25 to 30 years to own in a good socio-economic location, that's where I go. Personally, all my purchases that's where I go. Right? So I have no property other than one, probably that's the latest, because the data set took me there, which has anything less than 8 years sat. And anywhere.
So explain for everyone at home, ERSAT score.
Yeah. So it's a socioeconomic score, right? So it talks about how people can, so where they fit in the socioeconomic in terms of how much they earn, how the area behaves in terms of the people living there. So it's basically how much people make in the area, what kind of people are living in the suburb, right? So it gives you a metric. So with high scores, obviously that means people can spend the money. They got the ability to spend more. So you might find a property which, let's say around 700,000. But in reality, the affordability of that particular area is 30 years to own. I can take some examples. So we bought last year. Probably if you want me to give away a few.
Let's go. Give us one. Go one.
Just go on. Okay, let's take Seabrook, for example. Right? So yes, people talk about Cadams Down and others and all these areas. But there is Seabrook, which is a very small suburb with a good school, with everything. And if that score is good, and at the same time, years to own is around 30. Right? So the price point is 700, 750. But in reality, it's actually much affordable than Werribee and Melton.
Because the demographic there is earning more money than the Werribee demographic. But the area is considerably nicer and better to live in than Werribee. And we don't want to go against it. No, because Werribee actually has a good data set. But explain to everyone the difference between Seabrook and Werribee, for example.
Yeah. So as I said, the data is good for both of them, to be honest. But as I said, you're buying a property, let's say, for 550, 600 in Werribee, a decent one. Similarly, you're buying a similar data set, but in a bigger, better area, which is around the price point 650, 700. So difference is 100,000. The rental difference is probably similar. But let's say when the property becomes $1 million, Seabrook can go to $1 million. But
because of
the affordability. Whereas Werribee, even though it's affordable today, but let's say it goes through 800, but at that point, what happens is the socioeconomics of the area comes into play. Will that be still affordable? Maybe not. Right? Because some areas with, let's say, an IRSAT score of 9, 10, wherever you see that. So even though the property is $1 million, the people in that particular area can still afford it. It's still cheaper. So that's where I see that's my secret recipe, to be honest. All the properties that I try to buy is 8 to 10.
Yep.
I don't buy
and that's what you like. So
that's what I like.
So let's get one more example. So you like the high IRSAT score where people are earning good money.
Yep.
So it might be a double income family. They're into the six figures, and the median household income is strong, right? So in Cairns, you've done the exact same thing, right?
Yep.
So give us a good example of you looking at an area, and give us, even if you want to drop the area, we don't mind dropping the area because we want to give everyone value.
Yep.
Talk to us about the reasoning behind that.
Yeah, let's take, for example, Red Lynch.
Mm-hmm.
So that's a good...
Red Lynch in Cairns, yeah?
Red Lynch in Cairns,
Mm-hmm.
yeah. So, for example, we bought a property last year, 695,000.
Yep.
Yes. Sounds high for an investment property. Yes.
Yeah, because considering investment properties were 500 to
500,
550,
600 usually, right? So 600 is your cutoff mark, where investors stop going into those areas where it's about 600. But take this example. This classic, right? There's a reason why I say it's classic. It's 695. People say, oh, for a 350 property, I can go get rented for 400, 450. I'm positively geared. But take this property. It was bought for 695. It rents for 800.
So give everyone the context. So the property, what type of property was this? It wasn't the standard 311, right?
It's not. It's a 5-bedroom ex-display home on a 700 square meter block with a pool, the nicest of the area, nicest of the house. And just a house opposite to that, for example, went for 870 after we purchased this property, let's say in August. And we purchased this property in August. And you know what's the valuation in October?
What is it?
Just take a guess.
850 plus?
878. That's what the bank valuated at. And it's 3 months into purchase. We're sitting around 26, 27% uplift. Use the same thing. Go to the next data set. I use equity, went to the next data set for the buyer.
Yeah. So let's talk about that one. So you've gone for stock that the typical investor, now an investor that knows Cairns has the data set and is off to Cairns, the typical investor would be looking for the 3-1, or they'd be looking to try and spend as little as possible on a $500,000 investment property if they can, because or a 550 or whatever it may be. You've gone 695, where the majority of investors probably aren't very active in Cairns, and you've gone for a property that they wouldn't be looking for because it's in a good school zone, it's in a premium area, the IRSAT score is high.
It's 9, right? So IRSAT score is 9.
Yeah.
But the affordability, even today, if you go to the data set for Red Lynch, is around 27.
27 is
27.
It's
cheap.
It's still got a lot of room to run.
Yes. And you know what the average price point now?
Yeah.
You don't find anything less than 750. You don't find anything less than 800 really if you go into the market, try to buy it. Yeah. And still, the affordability is 27. That's the perfect mix for me because that's what I like personally. For purchasing properties for me, I want owner-occupier appeal and value. Yes, it sounds expensive, but look at the rental return. It's almost 6%. Where do you get 6% on a 700,000 property? Nowhere.
Yeah.
People try to buy 350, 400, all this property which needs a lot of maintenance, a lot of things, whereas this is like 10-year-old property.
Yeah.
Amazing layout, huge house. You don't believe it's a 278 square meters house.
It's a big home.
It's a huge home.
And let's touch on exit strategy. So exit strategy is important when trying to offload stock. So as an investor, if you start buying if you buy the 3-1, and I bought plenty of them in my time, but when you go to offload them, you got to be mindful, conscious of the fact that if you're offloading a 3-1 with absolutely no owner-occupier appeal, you will be hoping for a first homeowner, or you will be looking to offload to an investor. Now, if you need to exit that market during a downturn, or you need to exit that market and it's not particularly strong and it hasn't been performing for some time for whatever reason, you will struggle to find that buyer. Whereas with what you've purchased here, that owner-occupier in that good area, in the school zone, it's premium, it's a nice home. That's the type of home that someone could just do coat of paint, freshen up, nice kitchen. And that's always going to be a 278 square meter home. That's always going to be that home with the pool, with the large yard, that they can park their caravan on, or, Queenslanders typically have a boat, right? Especially in Cairns.
And it's a corner property. You got an option to put your boat
Yeah. So you pay. So you're saying you pay a little bit more, but make sure that the data and the metrics align. So the affordability is there. The ERSAT score will show you that the people can obviously afford it, and that in turn has them paying $800 rent. That in turn has them able to afford that property, even if it goes up.
Yes.
So
as I said,
you don't know where to go but up.
You don't find a property in the area now for anything less than 800.
Yeah.
It's just 6 months. If you think about it, that's
good 6 month money. That's more than the Australian wage in
exactly.
Yeah.
Right? So you're talking about 180,000 growth in equity in less than 6 months. Actually, the valuation came 3 months back. Probably now it's much higher.
Yeah.
Because it's moving on a weekly basis. People say, yes, the data set and everything, but when you buy the right property at the right value, I think that's what you have to look for. Going back to our next topic, we try to look for value. When I bought the property, for example, for the customer, so if we take that, we bought for $695, but Cairns was growing for the last 2-3 years. It's not like now, it's just started growing. Yeah. It's going actually for the last 2-3 years because after COVID, everyone started going. They actually bought the property after COVID for $650 plus times. Think about it. It's actually more or less close to $695.
Yeah.
2 years of growth was baked in nowhere. Where did that go? That's the value. When you look at valuation, when you're buying, CoreLogic was giving like 60,000, 70,000 more than what you're buying for. That means you already got 10% equity.
So you got in. So tell everyone, how did we get in and get that property? Because a lot of people would be looking at it and going, okay, Cairns is, there's a lot of people going for each property. There might be 15, 20 offers, right, we hear of. How'd you get that property?
Keep calling agents.
So you mean
keep calling agents, and they say no, yes, then yes, but keep calling them.
And eventually,
it's
persistence.
You know what happened with this property? Someone's finance failed.
Yeah,
but I told them I'm very keen and I want to buy in the area. Yeah, the first one they called was me and said, "Hey, I got this property. No, the previous offers were about this. I said I'll give you the lowest. What you're telling? Yeah. Are you okay? But I can sign now. Yeah, that's it. We closed it. Yeah, because there was obviously you can see if the previous owner bought it for $650, it's times it's around $680, and they want to offload it. But that means there is a distress sale.
It's a buy.
It's a buy because it's a distress sale. You know that there is an urgency. That's where you need to be shrewd and use your common sense. Hey, I want to do it fast. My terms are simple. You've got a pre-approval. Play that card because the finance failed previous one. So just go in. Yeah, and that's it. Got it. Property sold in a day. Yeah, you signed it. Yeah. 2 months later, you got 180,000 equity.
Wow, that's two deposits.
2 deposits. Yeah. And you know what we did for the customer? Yeah. We took that, we went to Mount Sheridan. Yeah. Same money, just went to the next one. Yeah. He bought another one.
Good data set.
Good data set.
That's it.
And
it's rinse repeat,
right? Once you know the game, you play the game.
Yes.
That's the point.
But that's what it is, isn't it?
Yes.
Everything. This is just a game. This is a game of finance and understanding data and what the next market is and buying that value. Yes. It's once you understand it. I've been using the term pattern recognition. Yes. Now I'm here 11 years as a buyer's agent. I see the same things over and over. I see the value like I've seen it in the past in Sydney, like I've seen it in Brisbane before. Everyone's seen it prior to COVID. Seen it in Perth. We've seen it in Cairns. Let's
not talk about the next one.
We're not going to. That's another episode. We're going to do another episode on that next hotspot that we're currently buying. But I simply just see patterns, and it's the same. We know the data. We know what to look for, and we know what's value. So we just go around and we just repeat. By there, couple of years, we'll be over here. Another year, 2, 3, 5, 10, we'll be over here. And it just continues on, and you keep scaling your portfolio because it's different to back in the day. When I bought my first home, which is just 20 years ago last week, I bought in Sydney just after the property boom, and I sat there. 8 years, didn't move.
Yes.
Same price. 8 years.
But you need to hold it when you have.
When you have, you need to hold it.
100%. No. Also, when you bought it right, remember, that will hold itself. Yeah. That's the whole point. That's what we're talking about. Going back to our secret sauce, when you buy a property in a good area with a good ERSAT score, even if it goes to a point where it gets stagnated, you already bought it right. It already grew. Yeah. And you're having a property in a good area with good socio-economics. That means your tenants are good. Yeah. Your rental yield was good, if not good now, but you can still hold it because when you purchased it right. Yeah. If you want to exit, remember, there's always expenses linked to your transactional costs, your BA costs, whatever. It's not recommended, and government takes half of it. as well. So why do you want to do that? If you can hold a property where you're not paying from your pocket,
That's the goal.
That's it.
Because you're holding that asset
Yes.
and it's not costing you. That's one of the biggest things in our investment methodology and scaling my portfolio and quite, a few others. We look at not sacrificing your week-to-week lifestyle and holding as many assets as possible because the assets will make you rich. Capital growth will make you rich.
inflation makes you rich.
Inflation makes you rich. It makes a lot of people poor. It depends. We're not going to go political now or philosophical. But going back to that one, I want to talk about the purchase price in the mid sixes, right? For a 278, what was it? It was an ex-display home, 278 mid ex-display home on a 700 square meter land with a pool. Pools are expensive to put in. When you factor in what that costs to replace that in today's money, it is not $650,000.
The new house from
area.
the same builder costs that money to build a house.
Just a house.
Just a house.
So it's free land.
Free land.
There you go.
There it is. And who's building houses now? No one. On time?
No one's
no.
building. No. I don't, and that's a whole thing to go through. So that's why
Right? So the next metric talks about building approvals.
Yes.
Who's building houses?
Yes.
The suburbs that we bought, right? Yes, there are a few areas which there would be because, for example, Red Lynch has got some land, people start building, but not a lot. You see the trend, always trend. It's not now. Okay, the trend is continuously going down. Be it stock on market, be it your inventory, be it whole building approvals, even the whole period. That's the other key thing when we look for. We want people who are there holding the property. And most of the times, who hold the property? Owner-occupiers. You don't want flippers, which is investors. Right, so you take Gosnells, you take Armadale, for example.
Mm-hmm.
Yes, there are a lot of people who made money, right?
Of course.
Yes,
I know some of them.
I know someone who made here, but
Yeah.
would I buy it? Probably not. That's my metric because I told you why.
Yes.
You got a property which you bought for 400. Now you're at 600, 650. You want to let go of it? Yes, great. You made short-term money. Move on to the next area. But can you hold that property for the next 10 years? Would you hold it? Would you get a 750 rent on that property today?
I don't know. I haven't looked at Gosnells lately.
Yeah,
It's not on the data set.
But someone who's paying 750 per
Mm.
week in Gosnells, I don't think they would want to stay there. They would go somewhere else and purchase in a nicer area, which is probably closer to the beach, closer to the city.
Yeah.
In a good school zone, whatever, right? So that's the metric. Obviously, yes, there are people who will make money short term because when the tide comes, everything lifts. But when it goes down, which one floats is what you need to hold.
Yes.
That's
True.
the whole point.
So in summary, that property that would be in an Armadale or a Gosnells is very different to the Red Lynch or Mount Sheridan property that is.
If you take Perth, for example.
Appeal. Yeah, we're using Perth versus Cairns.
Yeah. So probably take Perth, right? So we can compare, right? So if you take a Kingsley or a Greenwood or Duncraig was probably much more expensive. But if you take those areas around those, even now the data set looks extremely good.
Yeah.
People say Perth has peaked and everything, and people are trying to sell, especially the people who hold assets in these areas that we spoke about, where every BA went and tried to purchase. Now, if you look at the metric, the renter to owner ratio is all investors. If it's around 40, 50%, it's a big red flag. Because if you take a Greenwood, for example, the renter to owner ratio is 14%, which means 90% of the people are owner occupiers. They would never go, mostly. So rental is always in demand in a good school zone, closer to city. It's 10Ks to city. You bought 400 in Gosnells. I bought 570.
300.
Oh, you bought 300. So you're much earlier.
Yeah.
You know your game, right?
Yeah.
So I bought 500 in Greenwood. Yes, but now the average price in Greenwood is $1 million.
Yeah.
And projected to grow 1.2 in the next 1.5 years.
And it can grow.
It can grow. Why? The data set is
There's a
so
lot of
good.
the northern suburbs of Perth that actually has good data set.
Especially these are inner northern suburbs. It's not even outside.
Yeah.
Right? So that's the whole point. That's what I was trying to say. Can you hold the property? Yes, I can easily get a tenant today for 800. Can you get that in Gosnells?
So it's premium. So a lot of, because this is quite an interesting topic where there are a lot of buyers who just focus on your lowest socioeconomic style of properties.
Yes.
So I've done that starting out.
A lot of people do that.
Yeah.
And it's not wrong.
Because I can give multiple accounts of where, I've had a premium property in a premium area and had bad tenants who trashed the place, didn't look after it and so on. Then I had Mount Druitt tenants which were amazing. Looked after it, never got a phone call, never got a problem. Yes. So it just goes to show that you can get whatever. But the majority of properties in lower socioeconomic areas do struggle with quality tenants or issues. And a lot of those properties are older. Yes. right? They're not all new. So you do have a lot of maintenance and so on and so on. So 100%.
So that's the first thing I look for.
Yeah.
Can the property host nice tenants? So when you're shortlisting people, you want people who have got a stable job, who earn well because they're in an area, they're targeting an area where they're paying premium.
Yeah.
You know that they got safe jobs. They will be able to pay your money back.
Yes.
Right? So I can hold the property. That's what I'm saying. Even if there is a downturn, as I said, I'm not paying much out of my pocket because you bought a property for 550, which rents for 800. That's it. It's paying for itself.
It's a no-brainer. It's a no-brainer.
The property is now valued at $1 million. Yes, I can sell and go to the next market. But if you played well, if you know how to play your structures, you can always hold the asset, still buy the next one.
Yes. And that's why cash flow is important, because it's cash flow that helps you hold the asset. It's the capital growth that makes you rich, and that doesn't change.
It's a balance.
It's a balance.
It's a balance, right? So the next important metric that we see for is yield, as we spoke.
Yes.
The rental yields, which will drive all this. So it's the ability for you to hold the asset.
Yes.
And it's the ability for you to borrow more, right? This is what drives you to scale your portfolio. That comes from both rental yield as well as your growth. When you balance both, and when you know you can hold the asset forever, you never should sell an asset, even if you made money.
Yeah.
Because the cycles keep coming and going.
They do.
Right? You will play the game when you're in the game. Once you're out, you're out. The next time when you want to get in, the same property that you sold will cost you much more.
Yeah.
Because inflation drives prices up.
Yeah.
Everything drives prices up.
Yeah.
And why do you want to sell it if you don't need to sell it?
You should be looking to accumulate those assets to pass them on to your kids later. A lot of people with that, let's touch on that topic. A lot of people are, selling properties. So you have entry costs. So you may have your buyer's agent fee, your solicitor fee, your stamp duty. Yeah. You enter the property. Let's say you got to reseal a shower. Let's say you got to spend some money on it, this and that, whatever it may be. You got some holding costs. You make a bit of money, you sell, and there's another 20K on your exit or whatever it is, and the costs. And then capital gain, right? The tax office won't miss you. They will call you as soon as that comes about, because they'll get notified in their system that you've made some capital gains and you need to pay. So when you look at it, there's a whole heap of entry and exit costs. This is why it's crucial to make the right investment and not just sit there buying and selling, buying and selling, buying and selling. And if you talk to, this is something a lot of people don't know, but if you talk to many, many, many developers over the course of time, the majority will tell you that it would have been better if they had kept more.
Yeah, absolutely.
I hear that all the time from them.
But probably you might get wrong advice as well, because the more you churn, the more you buy. If you're with a team who is selling you or buying through them, I keep making money.
So you're saying that someone might have an advantage or a benefit to you constantly buying and selling.
Who gets benefited out of all these transactions?
Real estate agents, buyers agents.
Real estate agents, buyers agents,
ATO.
government, right? And who else? Your solicitors, building and pest, all these people. End of the day, you end up with the thinnest part of it. Because let's say you made 200,000, yes, great. But out of that, 50%, you probably have to pay tax. Not 50,000, not 50%. And 50,000 gone, you're left with 150,000. It's great. Then if you went through a buyer's agent, when you bought, you paid 15. Next, when you're re-entering, you're paying another 15. 30,000 gone. Another transactional cost with respect to stamp and everything. If you take it, you're not left with a lot. Why do you want to sell it? No. You should never sell an asset. That's the mantra, right? So
we were saying that just before the podcast. If you have an appreciating asset, you need to be holding on to that.
Yeah. So always markets stagnate. Yeah. Once it grew a point, stagnates for a period. Yeah. But nevertheless, you're not having any holding costs. Yeah. Then hold it. You can always enter, as I said, if you structure things well, if you're working with the right team, you know how to get, equity and then purchase the next one. There are methods, right? It's about knowing who to talk to and how to get it done. So
100%. So if there's one thing that one ultimate piece of advice for anyone at home listening that's embarking on their property journey, what would it be?
Hold it.
Hold it.
Hold it.
Simple.
Hold it. Because an asset grows. Everything else declines in value because inflation.
How do you buy a good asset? Use a good buyer's agent.
Good buyer's agent.
But
due diligence. Yeah. And the last thing we didn't talk about, and one of the key aspects is due diligence. Yeah. You talk about your risk. Is it in a flood zone? Is it in a fire? or what are the areas that are important for you to consider, right? So try to buy in a good school zone. Don't buy something closer to flood area. Or all these are very important. So you need to look at the risk aspect and consider the long-term trend. Also look at the GRC, the growth cycle. Where you're buying. Are you buying at the peak of a cycle, or are you buying at the bottom of the cycle? Because everything is a cycle. Something goes up, comes down, something goes up, comes down, or stays there. Typically, property doesn't come down by 20-30%, like your stock market, for example, whereas it might stagnate. But consider that you're entering a Gosnells now at 657 purchase. You will be holding on to a dud for next 5, 6,
So
7 years.
a lot of people do that. A lot of people have been hearing for years that there's a boom market somewhere, like, for example, Perth. And a lot of people in the second year or third year go, oh, you know what, I've been hearing Perth's booming. I'm going to go buy in Perth. Yeah. Well, when in actual fact, if you've by the time you've heard about it and you know multiple people that have bought there, odds are it's over.
It's over. Like, for example, where we're buying, probably now no one is buying.
Yeah, no.
So no one wants to even buy there, for example. But that's the whole point. When you put everything together, right? If you put everything together that we spoke, and you actually try to arrive at a location, people might not be buying there. So get in early, but hold it. Never sell it, right? So that's the whole point.
Yeah, get in early, hold it. Due diligence, and hold it.
Yeah, hold it. That's it. Hold it. Keep holding how many you can.
Yeah.
And there's always an exit strategy, right? So some people want to sell half of them, pay the remaining. That's all done later.
But you reassess your portfolio later. If you buy in growth areas and you get the growth and you got your 5, 6, 10 properties or whatever it may be, you may have a couple of those properties that you do sell. Yep. You burn them and then, put that money into properties that you plan on keeping long term, maybe granny flat a couple of those, increase the yield on your total portfolio, whatever it may be. As far as strategy goes, you're not going to keep every single property you ever acquire, but you should be keeping and holding the majority as much as you can.
And also during accumulation, don't plan to flip. Yes, if you're a renovator.
No, if you're just starting out, you shouldn't
just starting out.
Unless you're a builder.
That's what I said.
Your brother's a tiler, your other brother's a electrician, one makes kitchens. You can get away with doing stuff like that because you're in that every day, right?
If you're a passive investor, I'm talking to a regular everyday investor. Not someone
who's be flipping.
Renovator or a flipper, market. Whoever is doing, they do it for a different reason. But if you're a normal person who just want to hold the asset, the best thing, buy the property at the right time and also in the right location. Do your due diligence. Try to invest in an asset that doesn't cost a lot for you to hold it.
Well, this is good advice because I know for a fact you haven't done any renovations. Is that right?
Nothing.
No.
I haven't even seen any of them.
So you haven't seen them, you haven't done any renovations, you've literally just bought based on data.
That's it.
And hold.
And
that's it.
I didn't do any single thing, not even a paint.
Yeah.
Nothing.
Nice.
And my rents keep growing.
Yeah.
Everything.
Because you bought well.
Yes.
Yeah.
We bought well and probably all the rents went up 20%. And I'm not talking 4 5 years here. We're talking 2 years, realistically, right? Yeah. So my rents went up from where I bought them, right? So by 20%, most places. And the recent ones are amazing. I'm excited for the year. Yeah. What's coming? Yeah. Cairns is big. Yeah. Last year, there were 2 in Cairns. Yeah. So big jump already in terms of from what I bought to where they are. Yeah. And it's important. You know how to buy and where to buy. Once you know that, I think you're in the game.
Nah, done.
You play the game when you're in the game. 100%. You can't play from outside.
You can't. Jay, fantastic advice for everyone. I appreciate your time today.
Thank you so much, Michael. Nice to be on the mic, actually. This is the first time I'm here. But yeah.
It's awesome. Thank you so much.
Thanks for having me. Cheers.